Exploring asset liability management strategies, duration gap and maturity gap. In the realm of finance, effective asset liability management, ALM, is crucial for ensuring an institution's long-term sustainability. Today, we will explore two essential strategies: duration gap and maturity gap. What is asset liability management? Asset liability management involves coordinating a company's assets and liabilities to manage risks, particularly interest rate risk, liquidity risk, and funding risk. By strategically aligning assets and liabilities, organizations can enhance their financial stability and profitability. Understanding duration gap. Duration gap is a key concept that measures the sensitivity of the value of assets and liabilities to changes in interest rates. It considers the weighted average time until cash flows occur, providing a more dynamic understanding of interest rate risk compared to simple maturity matching. Importance of duration gap. Interest rate sensitivity. Duration gap reveals how much the portfolio's value changes when interest rates fluctuate. A larger gap indicates higher exposure to interest rate movements. Risk management. By analyzing the duration gap, institutions can identify potential losses and take corrective actions, such as adjusting the composition of their assets and liabilities. Calculating duration gap. The formula for calculating duration gap is where DA equals duration of assets, DL equals duration of liabilities. A positive duration gap indicates that assets are more sensitive to interest rates than liabilities, potentially increasing risk. Conversely, a negative duration gap suggests the opposite. Understanding maturity gap. While duration gap focuses on the sensitivity of asset and liability cash flows to interest rate changes, maturity gap examines the timing of cash flows. It compares the amount of assets and liabilities maturing within specific time frames. Importance of maturity gap. Liquidity management. By analyzing maturity gap, institutions can ensure they have adequate cash available to meet short-term obligations while maximizing returns on long-term investments. Interest rate risk management. Maturity gap helps identify mismatches in timing that could lead to interest rate risk, allowing organizations to adjust their asset and liability profiles. Regulatory compliance. Many financial institutions must adhere to regulations that require careful monitoring of maturity profiles, making this analysis critical for compliance. Calculating maturity gap. To assess maturity gap, institutions typically break down assets and liabilities into time buckets. Here's a simplified illustration. Time bucket 0 to 1 year. Assets, $1 million. Liabilities, $600,000. Time bucket 1 to 3 years. Assets, $900,000. Liabilities, $700,000. The maturity gap for each bucket can be calculated by subtracting liabilities from assets. Integrating duration gap and maturity gap. While duration gap and maturity gap serve different purposes, they can be integrated for a comprehensive ALM strategy. Balanced approach. By considering both gaps, organizations can strike a balance between risk and return. Conclusion. Understanding and applying duration gap and maturity gap strategies is fundamental to effective asset liability management. By leveraging these tools, institutions are better equipped to navigate the complexities of financial markets and stay resilient in the face of uncertainty. Thank you for exploring these essential strategies with us today. Ready to elevate your treasury expertise? Become a Global Banking Hub member to access exclusive courses, earn certificates, and get personalized feedback. Join now at www.globalbankinghub.com.